Welcome to vTalkInsight, Market Drivers Daily for July 1st, 2026. Today, an enormous wave of AI spending is colliding with a more hawkish rate backdrop, just as earnings and growth expectations are being marked higher. That mix is forcing a rethink of where equity risk is really concentrated and how durable this cycle might be. Across the AI landscape, the story is shifting from unqualified enthusiasm to a more contested reality. Large enterprises are voicing frustration that many AI offerings were oversold, with token-based pricing seen as expensive and often delivering limited tangible value. Concerns run deeper than cost because governments and corporates increasingly worry about intellectual property leakage, opaque model deployment, and who truly owns the data and model weights that drive their business edge. Those concerns are changing what clients demand from AI vendors. There is rising interest in architectures that let firms switch between models easily, while retaining full control over data, parameters, and how outputs are used, rather than being locked into a single provider. Profitability also appears to be gravitating toward application layers and integrated compute services, as seen in firms that monetize workflow software and infrastructure together, rather than relying purely on metered access to foundation models. At the same time, the capital expenditure story around AI is accelerating. Chip and memory manufacturers have significantly outperformed this year, powered by hyperscaler spending and new model rollouts, while many software names and the hyperscalers themselves have lagged. We have seen energy and infrastructure providers rally on expanded data center partnerships worth tens of billions of dollars. An Abu Dhabi fund raised $49 billion for AI, and a major industrial player commit over $3 billion to acquire an industrial AI firm, signaling a structural shift toward automation and digital transformation. Regulation and geopolitics are quickly becoming as important as technology itself. The United States has lifted export restrictions on one leading AI model developer after new safeguards were agreed, illustrating how government cooperation can unlock monetization but also impose ongoing oversight. Authorities in the U.S. and Europe are coordinating on standards for frontier systems. Central banks, such as the Bank of England, are warning about systemic risks from advanced agents, and security tests have shown that some models already possess sophisticated cyber hacking capabilities. All of this feeds directly into valuations and market structure. Equity gains have broadened beyond the largest hyperscalers, with small cap and infrastructure names linked to data centers and power showing exceptional first-half performance. Yet overall index breadth is still highly dependent on AI holding up. Market valuations look stretched relative to history, and the scale of any future correction is now seen as heavily contingent on whether AI delivers genuine productivity gains rather than just narrative, especially as AI-driven demand is adding to near-term inflation pressures. In contrast, policymakers and many sovereign investors still frame AI as a medium-term growth engine, arguing adoption is early, process-level change is limited, and productivity benefits are only starting to appear. That tension between early-stage promise and immediate macro side effects makes AI both the main growth pillar and a key source of potential instability. Turning to policy, the rate story remains dominated by cautious but hawkish central banks. Recent strong U.S. economic data, earlier energy price spikes, and sticky core inflation measures are keeping officials reluctant to talk about cuts, and in some cases open to further hikes. Markets currently assign a high probability to another Federal Reserve increase by September, while both the Fed and European central banks stress a meeting-by-meeting, data-dependent approach rather than firm forward guidance. Near term, the calendar is packed with catalysts that could move rate expectations. Euro area consumer price data and U.S. employment figures due today and in coming days are viewed as pivotal, especially with the U.S. labor market described as resilient and job opening ratios back near last year's highs. Speeches from senior Fed, ECB, and Bank of England officials, including a high-profile policy panels, are also under scrutiny for clues on whether July or September meetings might carry higher odds of action. For bond markets, the risk skew still leans toward higher yields. Persistent core inflation above target, upside surprises in jobs data, and the additional demand impulse from AI-related investment all argue that fair value rates may need to be higher for longer. The U.S. curve has flattened as front-end yields remain elevated, and there is concern that if the Fed resists hiking despite market signals, a sharper bond sell-off could follow as investors question its inflation-fighting resolve. A stronger dollar and this hawkish bias have already weighed on assets like gold, which is enduring its weakest quarter in over a decade, and helped drive sizable outflows from U.S.-listed Bitcoin exchange-traded funds. There is, however, a meaningful counter-narrative. Some observers argue that markets may be overpricing additional Fed hikes, noting moderating energy prices, slower wage growth, and the possibility that AI-driven productivity ultimately allows inflation to ease without deep policy tightening. In Europe, one more ECB hike followed by a pause is a base case for some analysts, reflecting concern over inflation but recognition that policy is already restrictive. What is clear is that central banks want flexibility, increasingly relying on interest rates rather than aggressive balance sheet moves, and warning that the shift away from explicit guidance will likely mean more volatility in yields and risk assets over the next couple of years. Against that rate backdrop, the growth picture looks surprisingly upbeat. Equity performance is being driven less by liquidity and more by earnings and nominal growth, with consensus forecasts for S&P 500 profit expansion rising sharply over recent months into the mid-20% range. Robust capital expenditure on AI and physical infrastructure, alongside buybacks and resilient demand, is supporting this upgrade cycle. Underneath the surface, a global spending supercycle is taking shape across AI, climate, and defense. Hyperscaler and data center investment is spilling over into adjacent sectors, from industrial gases and power networks to specialist real estate and equipment manufacturers, creating broad earnings tailwinds in the United States, Europe, Asia, and emerging markets. Stronger than expected Asian purchasing manager surveys and Japan's Tankan results have lifted regional equities, while very strong non-manufacturing sentiment in Japan points to domestic confidence that could, over time, support the yen if matched by a more hawkish Bank of Japan. Labor markets add another layer to the growth story. In the United States, declining announced job cuts, solid non-farm payrolls, and a high ratio of vacancies to unemployed workers point to renewed strength rather than an imminent downturn. Small caps have exited an earnings recession as manufacturing stabilizes, and recent gains have been helped by exposure to AI infrastructure themes, though elevated leverage and refinancing exposure leave that segment more sensitive to higher rates. Looking forward, the base case embedded in markets is for a soft landing with growth acceleration, helped by falling energy prices, moderating headline inflation, and powerful AI and infrastructure Capex. At the same time, there are clear vulnerabilities, including stretched equity valuations, heavy reliance on AI to justify earnings multiples, and potential cost pressures from trade frictions or supply constraints in chips, power, and construction. The balance between these forces will be tested by upcoming earnings seasons, implementation of infrastructure and defense plans in Europe, and how Japanese wage gains feed into Bank of Japan policy. To wrap up, AI has evolved from a pure growth story into a full system driver, shaping earnings, inflation, regulation, and even credit issuance. Central banks remain wary of sticky prices and AI-related demand, favoring a data-driven, higher-for-longer stance that keeps the dollar firm and rate volatility elevated. Yet the growth backdrop is still constructive, with upgraded earnings, resilient labor markets, and a global Capex supercycle arguing that the expansion has room to run, even if valuations leave little margin for disappointment. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.